Jordan, do you want to go ahead and start talking about book value per share?
Sure. So when you think about book value is essentially shareholders' equity. And you get to shareholders' equity by looking at the balance sheet and you look at assets and then you subtract the liabilities from the assets to get to shareholders' equity. And then from there, of course, you divide shareholders' equity by the number of shares to get your book value per share. And this is a really valuable thing to understand. Essentially, what shareholders own of a company once all the liabilities, the bondholders, the people who have given you inventories, for example, on credit, once they're paid off, what do shareholders have left over for them? And
So,
so understanding that value on a per share basis can really help you understand the value that underlies an individual share that you might own. So if you own 100 shares, then you can know what the book value per share is, know the basically the net value of those shares on for an accounting purposes.
so, I have a question for you. What about intangible book value?
So intangible book value, especially this is a financial show, so with banks, it's an important one. Intangible book value, especially for banks, is usually goodwill. So it's the value that exceeds the tangible value of assets from an acquisition. So if a bank buys another bank, they're not just going to pay one times equity. They'll pay something maybe 1.5 times equity, and the extra half times equity has to be applied to an asset after an acquisition. And usually that's subscribed to goodwill, which is basically the value of customer relationships, the value of the brand, things that necessarily couldn't be sold if you had to sell them. So
Right, it's not
obviously
a
you can,
printer. It's more
right, right,
feeling.
right. It's something that doesn't really exist, but it does. It's hard to explain.
Yeah,
So
absolutely. But I mean, it still factors into book value per share. So it's just something that you kind of want to keep in mind. You could, of course, do tangible book value per share, and tangible, of course, means things you can touch. So it's literally the assets that the company has, excluding any sort of goodwill that might be factored into the books.
right. So like when people look at banks, they usually like to look at tangible book value because it gives you a very good understanding of what the actual real liquidation value of a bank is. And also when you're measuring return on equity, which we're going to get to, if you're measuring return on tangible equity, that's kind of like a measure of how fast a bank could grow organically instead of acquisitively.
Okay, I mean, you kind of teed yourself up there. Do you want to talk about return on equity now?
So return on equity, once you've calculated book value, so you take your assets, you subtract liabilities, now you have your book value. Return on equity is you take the company's net income and then you divide it by the book value. So if a company makes $100 million on a book value of $1 billion, the return on equity for this company would be 10%.